Saturday, November 11, 2017. If you were wondering how Congress feels about the tax-exempt sector, you need look no further than the Senate chairman's mark of the Tax Cuts and Jobs Act Senate tax bill released late November 9, 2017. In what can only be described as a brutal attack on the non-profit sector, the Senate has proposed sweeping changes that would have dramatic adverse effects on tax-exempt organizations. Unlike other recent legislation targeted only at Section 501c3 and 501c4 organizations, the Senate tax bill would affect Section 501c5 labor organizations and Section 501c6 business leagues, and all types of tax-exempt organizations would likely have to modify their activities in many respects if the bill were enacted in this initial form. Specific areas targeted by the Senate Committee on Finance include executive compensation, the rebuttable presumption of reasonableness, unrelated business activities, and the scope and degree of exposure to intermediate sanctions excise taxes. Whereas the latest version of the House bill contains relatively few provisions of interest to tax-exempts, the Senate tax bill is a must-read for such organizations. Here are details on the major proposed changes affecting tax-exempt organizations, as well as additional thoughts on these provisions and their potential impact. 20% excise tax on certain levels of executive compensation. Like the House bill released a few days earlier, the Senate tax bill would impose an annual 20% excise tax on the total taxable compensation provided by a tax-exempt organization to one of its 5 highest compensated employees, to the extent that the total exceeds $1 million. This would include any employee who was one of the 5 highest paid employees in any previous year after 2016. The employer would be liable to pay the tax. All related organizations would be aggregated for the purpose of determining whether the $1 million threshold is exceeded. In addition, the 20% excise tax separately would apply to any excess parachute payment. This refers to any payment that is contingent on the employee's separation from employment, where the aggregate payment is 3 times or more the average annual taxable compensation in the preceding 5 years. The tax would apply to the amount that exceeds the portion of the base amount applicable to the parachute payment. Note: a possible interpretation worth watching out for is whether deferred compensation amounts that become payable upon separation from employment would be subject to this golden parachute excise tax. If so, exempt organizations should consider eliminating employment termination as a trigger for payment of deferred compensation to the extent permitted under these arrangements and under tax law guidance. Sweeping changes to executive deferred compensation. The Senate tax bill would eliminate pre-tax contributions to Section 457B eligible deferred compensation plans, starting in 2018. These plans permit separate contributions by highly compensated employees, and by their tax-exempt employers, up to an annual limit similar to that of 401k plans and 403b annuities, currently $18,000 per year. In addition, the complex rules for 457F deferred compensation arrangements, including the notorious 409A rules that apply to these arrangements, would be eliminated for all compensation payable after 2017. Any new deferrals of compensation would be made, if at all, only under a simpler structure that would consist of these principles. Deferred compensation would be taxable when it is no longer subject to a substantial risk of forfeiture, the same general rule as in Section 457F now. Substantial risk of forfeiture would be determined only by a substantial future services obligation. A covenant not to compete would not qualify as a substantial risk of forfeiture in any circumstance. A severance payment would not. Fair market value of assets other than those assets used directly in carrying out the institution's exempt purposes is at least $250,000 per student. To put that into perspective, generally a private college with an enrollment of 10,000 students would be subject to the tax if its endowment assets exceeded $2.5 billion. The tax applies to the net income of the entire investment portfolio, not just those assets that exceed the per-student threshold amount. The term college or university for this purpose includes the college or university and all other organizations under common control. As currently drafted, investment losses from previous years may not be used to offset gains in a current year. Repeal of tax exemption for professional sports leagues. The tax exemption of professional sports leagues has been in the news of late, with the National Football League voluntarily relinquishing its tax-exempt status. Historically, such organizations have been accorded tax-exempt status as business leagues under Section 501(c)(6) of the Code, which expressly provides that professional football leagues, whether or not administering a pension fund for football players, are entitled to exemption. Over the years, Congress and the IRS have interpreted this phrase to apply to professional sports leagues and associations generally, not just football professional sports leagues. The Senate tax bill proposes that Section 501(c)(6) of the Code be amended not only to delete the phrase professional football leagues, but also to add a statement that expressly provides that Section 501(c)(6) shall not apply to any professional sports league whether or not administering a pension fund for players. Charitable contributions involving college athletic seating rights. Historically, contributions to a college or university where the donor received a right to purchase tickets to a college athletic event were partially deductible to the donor as charitable contributions. Specifically, a donor who received such rights in return for a charitable contribution was entitled to take a charitable contribution deduction equal to 80% of the donation. The Senate tax bill would amend Section 170L of the Code to state that no charitable deduction is allowed for payments to a college or university where the donor receives the right to purchase tickets or seating to an athletic event. Repeal of advance refunding bonds. The Senate tax bill contains one item of good news for Section 501(c)(3) organizations. The House bill released last week proposed to eliminate the tax exemption for interest on private activity bonds, a critical source of capital for 501(c)(3) hospitals, colleges, universities and others. The Senate tax bill takes a narrow approach to bond reforms, only subjecting bondholders to income tax on interest received from advance refunding bonds. While this change would limit certain types of refinancings, it comes as a welcome relief for charitable organizations reliant on tax-free bonds for their infrastructure and future growth. Conclusion: it is important to bear in mind that the initial Senate tax bill is one step in a long process, and that both the House and Senate versions are likely to undergo many changes as this tax law overhaul advances. However, given the far-reaching implications of these potential changes to the exempt organization sector, the Senate tax bill in particular deserves close monitoring. Copyright 2017 McDermott Will Emery.